And in our side, we, as you know, part of our work that demonstrates the agricultural work that we carry out, we prepare work plans, and then we negotiate contracts, etc. So then you have your invoice management, and then you actually have to do the work. And by doing that, there's that whole range of audit tracking processes. Mileage you put in, the types of inspections, the time worked on it, and you have to be able to withstand an audit, and that includes all of your documentation of your work plans and your state reports and your invoices that demonstrate exactly what you did and how many, etc. So that's our side. Next. So just in the sense of subvention payments are made for the amounts based on a formula in the law. Now, there's one code section that I reference is the commissioner's salaries, California Ag Commissioner salaries on that section 2223. That has been basically negated, and no salaries are funded. In years ago, it used to be $6,600, and then it was batted down to $3,300, 15, 20 years ago. I'm starting to age myself. And then they basically quit paying. And then there's this element of the seed law enforcement, and then there's the actual unfunded gas tax is in terms of funding under 224. So what you'll have to do is, as we go through this, just sort of keep these in mind and recognize that the Food and Ag Code 224 is the basis for the funding and the formula associated with that. Okay, next. So the process for local assistance is payments are made for support of local government or other locally administrated ag programs. And these are just a couple examples that you're familiar with. The high-risk trapping activities, you can go on next. For example, these are contracts and agreements for which all qualify for reimbursement for unclaimed gas tax. These are all familiar, and of course there are others. And I put a question by the weed management, since we've been through sort of a tussle over time with the department on funding availability in the weed management groups, etc. And so I just put that up there just in case at some point the funding is reinstated, then those work plans could be negotiated as part of payments to the county. So all of these programs qualify for unclaimed gas tax. Okay, next. The things that do not, and as most of you know, is what we call below the line or on a financial statement, but we'll get to that later, is the weights and measures programs. Those are not associated with calculating or processing maintenance of effort activities that the county is associated with. Okay, next. But the financial service branch has some activities involved here. They maintain the County Ag Commissioner's Annual Financial Statements Procedures Manual. So we have to comply with the CDFA's service branch's request, and they have their manual. And then we obtain the financial statements from the counties, and then we provide DPR with the PUE information. So we have sort of a bifurcation here, and then you end up calculating the net county expenditure data and the distributions of the appropriations. that are in that particular Food and Ag Code section. So there's sort of a process here in which the information is reviewed in a group and determine if the criteria meets the Food and Ag Code 224.5, and if it's not met, there's a process for that. And then of course the department ensures payments due from unclaimed gas tax are allocated. But back to that, the group one. We'll get to the number 5. We'll talk a little bit more about what this group process is in terms of how it's reviewed and who plays a role in that review in a future slide here. Okay, next. So on to the unclaimed gas tax part of this. So the sourcing of the gas tax is from the excise taxes collected on motor vehicle fuels deposited in the motor vehicle fuel account in the transportation tax fund. So that's sort of outside of our sphere. We don't dabble in those funds or accounts. But the section 8352.5 of the Revenue and Taxation Code requires fuel taxes attributed to unclaimed or unrefundable agricultural gasoline tax used for off-highway vehicles to be transferred into the motor vehicle fuel account to CDFA. So there is the source of the funding and then the mechanism to transfer the money into the Food and Ag account. This is something a lot of people, and it's sort of difficult to wrap your arms around because it's the equipment that is used on the farm and not necessarily those that are associated with registration of a typical vehicle on the road. So these are special agricultural equipment. It could be weed whackers, small vehicles, tractors, etc. Okay, next.
Hey Stacy, before you move on,
yep.
Is it gasoline and diesel?
I believe it's only gasoline, but if the rep on the department side can correct me, I think it's gasoline only, but I might be wrong with that. That's a good question. I'll find that answer out.
Yeah, my understanding is that it's only gasoline. Christy, are you there and could maybe chime in?
Yeah, I believe it's just gasoline as well. I don't think it's diesel, but I would have to double check that just to confirm.
Yeah, I'm actually more I think about it, that is a very true statement. It's only gasoline.
Yeah, so it's the idea is that if someone, gasoline does not have a red dyed fuel equivalent like diesel does, and so if a farmer is using diesel, they can obviously opt to purchase the dyed diesel, which does not have the road taxes charged on it, and so that's why it's cheaper. Where gasoline, there's not like a red gasoline that's sold similar to diesel.
Yeah.
And so therefore you have to apply on your taxes in order to get a refund for your off-road gasoline, which most people don't do. And so that's why this pool of, quote, unclaimed gasoline tax exists. Is that correct?
Exactly. That's correct.
Okay.
Very good. Thank you. So, so that the tax is estimated and then calculated on a biennial basis, and the amount. So this is sort of a review. So the calculation is performed with the California Department of Transportation, and it's reported. The report is prepared by the legislature, and this is an important step because this is sort of the audit and the watching eyes above all the way up into the legislature on how these funds are prepared and determined and legitimized. And this is not just, you know, a pass through the Department of Transportation, but in fact there is an in-depth review. And so I think I might have a slide coming up on next slide. So here's an example. This is a 09 report because that's the only one I could find that I could scan or got from the department. But this is a report. So they do this biannually, I think, every couple of years. And so you'll get a report to the legislature on this fund. And it talks about how much and you know what the process was, and you know we've had a large increase a few years back, and so there's this constant watchful eye on this fund. We've had experiences also along the way with you know legislators creeping and looking at this to determine when there was really bad budget times, if this fund could be more like a fungible fund, meaning transferable into other activities, and a lot of things are pretty tight. So we're always keeping an eye on how we evaluate this fund and how it's used, and that we're doing the best job we can to be accountable for this money, because it's very important that if there's any appearance of misappropriations, or not so extreme in those terms, but the idea of keeping an eye on this, how we use it, and what's the benefit derived from it, helps us support and maintain this fund. Okay, next slide. So it goes through and it talks about how this is small print, but it tells you the average price of gas, and they go through how many gallons and how much percent was off-road, and then they come up and they calculate, and this is just a table out of the whole report, but it gives you an idea that this is a summary of how much money is available for the unclaimed gas tax available to counties. Okay, next. So Section 224 identifies how the funds are to be expended, and in this chapter in 2007, it amended the schedule of distributions of 224 by adding provisions that became operative in 2008, and these provisions sort of tightened up, and we'll get to that, but it tightened up the procedures for receiving this funding. And one of the reasons that in this July 08 period was so important is that the gas tax spiked up significantly. And there's a lot of stories that can be told, but I'll give you the one that's probably the most legitimate, is that some counties received a lot of revenue in addition to what they were traditionally getting, because the gas tax went up so much that the counties, in their rightful thinking, said, well, this is just additional revenue and we'll deposit it in our general fund. And in some counties, didn't have that much control of how it would be used, and so there was this fear that the money would come into counties and not be appropriately used back into agricultural programs. That we looked at that list before, all the agreements and contracts, and putting money toward programs that will benefit your local ag community. So this Assembly Bill 1713 was specifically drawn up with the intent to define processes that would control the inabilities, or reduce the abilities for counties to acquire these additional funds and not have it benefit agriculture or be used in the agricultural commissioner's office. So this is important. So just next slide. So In that fund, the unclaimed gas tax allocations have been developed around these code sections to fund various activities. So as you can see, there's a $9 million fund from CDPR to counties to do PUE activities, and of course we pay for our liaison's office with $250,000, and I think that, I don't know if that number has moved. I'll just assume these are correct unless someone pipes up and says they're not, but I believe that the gas tax number floats a little bit on some of these emergency funds, but these are what's allocated by each of these activities. Trapping gets $3 million, administrative activities, overhead for the department is 1.5, and then ag services, those are goes to the county ag programs, are 21,078, etc. So if you combine the $9 million at the top for DPR support and the 21 down at the bottom, and then you just sort of weight around those other activities, you can sort of see the significant fund is $30+ million that are available to counties, in addition to trapping and emergency services. So the department gets some with the liaison and overhead, and administrative services sort of controls about, $2 million of it, but the balance is available to counties. Next slide. So how does this sort of fall out in terms of tracking this and making sense with all this money, with the sourcing of the funding, and how do we document what we do in order for us to qualify for those funds? Because those are all in a pool. They're not just allocated just by, Marin County doesn't just artificially get some percentage, or Placer, or anybody else. It's all has to be slated out, and it's paid from what you do from the year before's work. So the financial statements that are now due to the department will be used for next year's funding. So last year's statements were used to fund into this year's revenue. So it's always paid in arrears. You submit your reports, and then you get paid at a future date. Okay, next slide. So the annual financial statement procedures manual sort of guides the process, and it tells you what you're supposed to do, and informs, it allows for uniformity in reporting your ag expenditures, revenues, and reimbursements, because it's actually the net county costs that drive this process, and we'll get into that a little bit more. So you take in your revenue and you have your expenses, and then you subtract those two, and you come up with a figure. So the procedures assist counties in preparing and presenting their financial statements. Okay, next. So here's just the table of contents for the procedures manual, and it hasn't really changed. There might be some nuances in there, but basically this is what you get. So it tells you by program, and it gives you an overview of how you go about this process and procedures for each of these activities that are qualified for gas tax. Next. So let's see. So this is sort of a due date. October 31st is when reports are due, and there's nothing precluding you from submitting them earlier. But as a general rule, counties don't close their books out right at the end of July 30th, so or June 30th. So July 1st comes around, the new fiscal year. There's a lot of things that are still hanging out there. There's encumbrances, and there's late payments and invoices and receipts that might not be in. So nobody in my history have ever seen anybody file a financial report on July 1st, on the opening day of the books or the closing day. You know, it's not, that doesn't happen. But in the process of allowing it some extra months, it allows you to get the auditor's report, the financial statements from the county. It allows you to do your own independent financial statements and processes following the procedures manual, and have a to allow you to have that nexus to compare the county's documentation to your own, and so you can reconcile any differences and make the numbers correct. So it's a recap of everything you do, and it's allowable direct and indirect costs and related to revenues and reimbursements. Okay, next. So here's a financial statement, and it lists the expenditures on one column, and it gives you the report number from which the sourcing of the costs and revenues were derived. And it allows you to, now this looks simple, but this is a collection of a whole year's worth of state reports, one after another, collectively and additively continue to grow and document what your total expenses were for these programs. So if you take you know, pest detection in this case in report 1, you know, this is a summation of your whole year, $295,059, and then your revenues, which came in. Now, of course, we all, in our best dreams, would want a zero net gain. You know, it'd be nice to have full reimbursement for the work you do, and contracts would pay you everything that you are so well earned. But as you know, federal funding and state funding is driven by several factors. The Farm Bill is a correcting factor, and a lot of times the sequestrations and things like that sort of discount our programs, and the funding's not available enough to go around. So the counties, you know, are on the hook for a lot of general fund, and hence the associated net county costs. You know, it drives this unclaimed gas tax source. If you look down at down here midway, it says regulatory support reimbursement, and that would be your unclaimed gas tax that you received from the department in this case, and then the next line down is the revenues that were received in a payment from DPR. So if you add those up, in this case it'd be about $260,000. So you have to account for those, because those are accountable on the revenue. But they're not accounted for in terms of the overall calculation. So, but they have to be stated in here. So next slide. So, you know, here's, as you would expect, a worksheet. So it would have, you know, how you prepare your program hours, the cost, and then you know, have these collectively add up. In this case, this is just showing direct labor costs for a particular program. So this is built into these calculations in order to come up with the total cost per program, which is important. I mean, it's integral into it. So you have program costs and you have individual costs, and then you have to reconcile those together. There was something else I wanted to say about this, but I'm not coming to me right now. Next slide. So once you make these calculations and you come up with your year-end fiscal year statement on reportable expenditures and receipts, you show everything here. And so there's these procedures that you go through to show salaries, service supplies, capital assets and other charges. And then you have your overhead costs, the A87. Now the overhead costs, this A87 typically represents basically an indirect support for services that you receive from other agencies within the county organization. So it may be printing, it may be your carpool, it may be your IST group, it could be your county council, it could be a whole range of people who have a cost associated with helping operate your office. Human resources can be involved, and it could be any number of things. So there's a connection there to where those are important numbers. So that 87 represents a federal directive, and it's like there's another code section that's eluding me now. I believe it's the Federal Code of Federal Registered. What does that go? How does it say? Federal Code of Regulations. Thank you.
CFR.
And, yeah, and there's guidelines in there that are more specific than I'm making them. That in order to have overhead costs, etc., how you identify them, how they're accountable, and if they're legitimate. And so those are important things to reflect on. And I think it's in the CFR 225, if I'm not mistaken. That just number comes to me. If I'm wrong, I'll correct myself if it comes to me in a different. But it helps guide on what qualifies for overhead and all these other ancillary activities that are reportable or chargeable. So now you have your total expenditures, and you come up with your revenues, and you submit this. So next slide. So the Food and Ag Code 224.5 is the maintenance of effort home base, which is described in our Food and Ag Code. This is the criteria for which qualifies you to receive unclaimed gas tax. And going back, the big fund that's unclaimed, it's put in to the transportation fund. The legislature overviews it. There's a biennial review. The fund is made available to Food and Ag, and now you submit your financial statements saying I qualify for the fund, and so then you submit your report and you say, am I really qualified? What else is in that section that was that 2008 legislation, that AB 1713? So here we go. So what's the home law say? Next slide. That code identifies a criteria each county must meet in order to qualify for Food and Ag Code funds, which is the 224G, is the unclaimed gas tax funds that we talked about, that $30+ million. So we call this the maintenance of effort. So next slide. So here's the criteria. You have to have an ag commissioner. And I know that this sounds sort of funny, but, and some counties are probably laughing, do we really need our ag commissioner? And I'm glad these are muted because I can hear you laughing now. But this drove the concept that some counties went on and on without replacing their ag commissioner because of some reason or another. And the criteria was established so counties would be very responsive and immediately recruit and replace commissioners that retire or otherwise move to another county or whatever. And so this criteria was important because there was a lot of foot dragging going on in some counties, thinking that they were going to have some salary savings likely, or maybe they were unsure about the process, or maybe they didn't have an effective HR, or the administrator didn't want to move, or the board wasn't sure if they liked the candidates, or all this stuff. So this helps drive the process of recruitment and putting a commissioner in place. Okay, so then the next one is submitting the agriculture expenditure reports in a timely manner. So, this October 31st date is written in the policies in the code, and this helps reinforce that you're going to get your financial statement turned in on October 31st, or you may be subject to not receiving unclaimed gas tax. Now, I don't ever remember this happening, but this was part of the process to keep bureaucracy moving. And then this is the part that was sort of the keynote of some of the things I talked about earlier, was to maintain county general fund support for ag commissioner service at least equal to the average amount expended for the 5 preceding fiscal years, with the caveat that unless the county is facing unusual economic hardship. And we'll talk a little bit more about, we know we've had those years, and so what was the process and how did we address that? But the key is you have to have a commissioner, you got to get your annual financial statement turned in on time, and you've got to maintain an average expenditure for over the last 5 preceding fiscal years. And that fit nicely with that legislation when the funding went way up, the money being skimmed off to go to support general fund. This reinforces that funding is supposed to go back in that county ag programs. Next slide. So CACASA leadership and CDFA reps created a work group which developed a methodology for calculating this average expenditure for ag programs. So we worked it out, and we came up with a process, and it helps. Basically, it's determination of county maintenance of general fund support will be based on analysis of the net county expenditures. The following data will be included when calculating the 5-year average for county ag programs. So the data is pesticide use enforcement, how much unfunded gas tax reimbursement you received. Next. So while PU activities are not overseen by the Secretary of Food and Ag, CACASA felt that the activities were integral, or probably one of our biggest programs. So we had to include that in our calculation to sort of represent not just Food and Ag Code requirements, but the DPR requirements. And then the inclusion of the gas tax reimbursements will reflect the county's direct commitment to ag programs, and data is more appropriate for calculating the true net agricultural expenditures. So if you have this revenue, it really represents that it's going back into your program, and that helps you make this finding that your commitment to ag programs is supported. Next slide. So when you go through this process, and going back to the financial statement, is to identify the grand total. So you have your expenditures and your revenues over here highlighted with the blue arrow, and you have to use that information to make the next few comments legitimate. So that reimbursement, so that the the differences between the two become sort of the balancing act of how much you put in revenues and how much expenses you have. Okay, next slide. Let's see here. So here is the sample of showing prior fiscal years, and this ends in 08, but it doesn't really matter because the rolling average is appropriate if it's 08 to 12, or in this case, these years that we're showing here. Is that it shows the expenditures on the net county expenditures on this one column. Gives you the 5-year average is 295,113. And so the report you submitted in 08-09 would have to be equal to or above that 295 to show you that you maintain the average amount. So if you take the above years 1 through 5, and there's your average, 295, and your current report is 256, then you're below by $39,090 is below the 5-year average. And you'd say, well, gee, that's not very much. But that is what triggers the steps that are that follow this in terms of explaining that you have had some kind of a problem or an economic hardship that we talked about earlier. So here's an example of a 5-year calculation that did not meet the 5-year average and was below. So this is how you identify the process. Okay, next. Let's see here. So you keep doing this process to adjust the formula each year. So you roll off the oldest data, take it out of the formula, and add the most current data to continue the 5-year rolling average. Next. Okay. So having said all that, and you see the rolling average process, this is sort of the calendar that drives the steps that take place once the financial statements are turned in and reviewed and the calculation are determined by the counties, by the way. You submit that in with your financial statement showing your rolling average. So come December, the county and the state liaisons will inform CDFA and CACASA president of any counties where a full-time commissioner has been employed. So we know that, you know, who's out there, and then the CDFA financial branch will complete the analysis of the county financial statements and look at the calculations for the 5-year average. So once that's done, and assuming that everybody's got a commissioner, but there's several who don't meet the 5-year rolling average, which has been the case this last several years. Come December, and that 20th, I bolded up the font a little bit. This is the letter that you get if you don't make your 5-year commitment, and this is the process. So the maintenance of effort letters and calculation charts are sent to each county CAO for counties that did not meet the 5-year average. Now this could be a good experience, or this could be maybe a not so good experience. Depends on how the commissioner utilizes his awareness of his board, his administrator, and the conditions of his budget. You know, it's always better to be open with your administrator and your board as you're doing these financial statements, acknowledging your position in this 5-year rolling average. You don't want to be the guy that gets the letter down at the administrator's office, and you haven't taken the time to chime in on the status of your financial statements and you're not making the 5-year maintenance of effort. So the key here is, you know, being open, being honest, being upfront, and trying to identify with the administrator that, you know, we've got to make sure that we maintain this maintenance of effort. And if you can't do it in 1 year, because maybe the differences are too large, you do the best you can to adjust the forthcoming years to bring that average back into an acceptable 5-year average and not be broken out and not meeting year after year. This is a serious spiral downfall when you don't make this each year and you keep going down, because it's hard to receive further unclaimed gas tax when your net county costs keep going you know, down. It's a wicked spiral, and all of us commissioners that have been through various budget life cycles of ups and downs have faced this. And you know, like currently in Marin, I have an agreement with my administrator that, you know, if I have a banner year with gas tax, that I don't, you know, step in and have some expectations that somehow I'm going to get some additional revenues for expenditures unless I fear that my expenditures to meet the 5-year average won't be met. And at the same time, if I have a bad year, he understands on the gas tax reimbursement, if I don't make my budget account for that line item, that, you know, he's not going to say, well, you're going to have to cut a position because you're short $60,000 or $80,000. And so, you know, this is a love-hate thing. But when you realize that it's flexible and mobile, you have to really concentrate on where is that fine line between how much the county spends on your ag department, how much revenue you get. Start doing some math. You know, there's this magical button that's always been pushed. It's like 39 cents on the dollar or 40 cents on the dollar that's reimbursable for your net county costs. And if you sit around with your calculator and play with that number a little bit, you start seeing how much you need next year to make your 5-year maintenance of effort rolling average, so you're not below and your CAO doesn't get the letter. And of course then he's got to respond, which means you're going to write the letter and respond, and the board is going to be aware of it. And so now, you know, you got to be thinking, projecting out 1, 2, 3, 5 years. You know, what's the best case scenario? And present that to your administrator. Say, you know, if we just make this much expenditure, we'll be able to maintain our maintenance of effort if that same formula holds up at that 39 cents on a dollar or 40 cents or 41, whatever. If you play with that number, you can forecast your maintenance of effort and put it in your budget, saying, you know, these and identify programs where you'd like to have expenditures, or, you know, you need some improvements, or you need new vehicles, or you know, whatever it might be, equipment, and you know, think it through. This is not just the end of the road that I get a letter and now I just have to tell them why. That's a shortcoming. The correct answer is, you know, I want to make a projected 5-year plan, so I don't keep landing in this 5-year, you know, syndrome of not making my my maintenance. So, and then these other dates over here, I'm sorry I said enough about it. You get the concept. These other dates are processes for which, and you can read these at your leisure, of how the next steps go about to remedy this whole process from start to end. Okay, next. Yeah, okay. Well then, this is the letter that you get from Food and Ag. Basically the same, saying you didn't make your maintenance of effort. And next slide. Okay. next, that's the last page. Let's see. So guidelines for economic hardship under Food and Ag Code. These are hard to read, but basically it's the ones that have worked in the letters, has really demonstrated that you've had, a serious reduction in overall county functions. And each department has an equal, role or have played equal reductions to some degree versus, oh, it's just the ag commissioner we're cutting, but the sheriff has not had any cuts. So those are the kind of things that are peculiar. We don't want the ag department to be the only guy on the block taking the hits, and we'll just, chip away at him. So there's really sort of an emphasis on, you got to have an ag commissioner, you got to submit your reports, and you got to maintain your program. But, you want a fair level playing field. So you got to stick up for yourself. I guess that's what I'm getting at. Next. Here's the things I was talking about. I knew they were there. It was just on another slide. It's a revenue reduction. The supervisors are furloughing people. Everybody's involved in a freeze. The things go on and on. So read this over. These are some of the things that will pass muster. Next slide. That's the end. So having said that, I'll let Josh, and if I missed anything, or if any of whoever's out there, I don't know the roster, but you're all welcome also to call me if you were unclear or I was going too fast or I missed something that I thought I should have said and I missed. You're always welcome to email me. I'm sure you can find my email address. And of course, you can work with the department and Josh, and I'd be glad to help any of you if I can to acquire your appropriate licenses. And don't give up so easy. Keep at it. It's not easy, I know, and there's a lot of information there. But
hey,
yeah,
really appreciate it, Stacy. Thank you. That was very thorough, and I think this will be a key PowerPoint. I'm going to send this out to everybody that attended today's webinar, and also, of course, we'll get the recording up on YouTube later. We do have one question so far, and that's, can you please explain what the word subvention means?
A subvention is a fund that is transferred from one agency to another. It's subventing funding for an activity. So a subvention would be equivalent to monies that were passed through agencies, and could be a federal to the state and then state to a county. So a subvention is a term used for transferring funding for a specific activity, possibly through multiple hands or agencies.
Yeah, I personally think of it as when the county, in real simple layman's terms, when the county does something that the state wants the county to do but doesn't necessarily have direct contracts for the county to do it, that's when some, funding may come in to subvent some of the counties or replace or make up some of the county's expenditures that they've previously spent.
Yeah, I think that's another way of phrasing it.
Yeah. So I'm not showing any other questions. Okay, I've got another question now. Regarding egg inspections, produce inspections, and organic inspections, are these unclaimed gas tax funds used to reimburse counties through their established contracts with CDFA? I think what they're asking for is the difference between unclaimed gas tax reimbursement and the state contracts. That's a good question that could probably use a hair more clarification.
Well, you know, state contracts are not always 100% funded for the effort or work that you have to do. So, so a contract, you develop a work plan, and there's only so much funding available to go around, so only certain activities and certain amounts are available, and so you're reimbursed for those activities. I can think of like high-risk pest exclusion. I think we probably, you know, exceed that by a factor of 10
Right.
in actual costs. So those expenditures that are not contractual qualify by default because the revenue that you receive negates up to the expenditure for that contract. Any expenditure beyond the contract amount qualifies for the unclaimed gas tax. So it's the second best. It's like a stepchild. You know, you get $1 for $1 on a contract, but on the unclaimed gas tax, you are only subject to that 39, 40, or 41 cent recovery.
Right.
And so that's the difference between the two. Is that you don't get, even in pesticide use enforcement, you know, there's probably, you know, and I don't know, I can't remember, but I think it's sort of like, you know, $25 million worth of work goes, you know, into out there, and yet, you know, the unclaimed gas tax picks up $9 million, and then the mill funding picks up another portion, et cetera, but the county still, that unclaimed gas tax represents what is not reimbursable.
Right.
So both sides get the benefit of not having, you know, a dollar for dollar contract.
Yeah, I think, you know, in just real simple terms, say you have an organic program and the state contract is $5,000 to your county. You spend $10,000 on the program. That means that you've spent $5,000 of CDFA contract and $5,000 worth of county general fund on that program. So then that $5,000 of county general fund is your net county cost on that program, and that net county cost of $5,000 then becomes an unclaimed gas tax reimbursement of about 40 cents on the dollar. So you know, when Stacy, I was thinking when Stacy was talking about talking to your county administrator about that downward spiral you can get in, it's kind of good to think of it in that way, that really when you spend $5,000 on that organic program of county general fund, you're not really spending a true $5,000. You're spending maybe $3,000 because that unreimbursed, you know, that general fund expenditure does have unclaimed gas tax that comes back and you know, reimburses you about 40%. So, you know, those general fund expenditures can really, you can stretch those dollars via gas tax.
Those efforts are the efforts that help you maintain that maintenance of effort 5-year averages by the commitment of the county to keep and maintain, you know, activities in the whole breadth of your department, and then they become eligible for reimbursement.
Yep.
So,
okay.
Yeah.
Next question is, what are emergency projects? I think that's referring to, what is it, the $3 million in 224 money?
Well, if you know, if a project pops up and there isn't a particular line item for that, the funds are used out of this emergency fund until appropriations are made either from the federal government or from the state to, you know, backfill the cost or develop, you know, a budget to eradicate a pest, say. So the funds are typically like jump-starting county programs and or state efforts to initiate controlling pests. So that's typically the use of that fund. And at the end of the year, which I didn't mention this, but those funds remain available for emergency projects, but there's, but if there's monies that go unexpended in the unclaimed gas tax, and there is a interest that's accrued, and at some point in the fiscal year you receive an unclaimed gas tax check, and then you also receive an interest check on monies that were not expended but yet grew in the account and then are reimbursed to the county. So there's a little sidebar, a little sort of a footnote that sometimes those interest reimbursements are made to counties for monies that go that remain in the account and collect interest.
Yeah.
So those are primarily emergency projects, and they help counties get started, and the state to be involved as oversight.
Typically eradication projects, aren't they?
Correct.
Okay. Next question, maybe one I'm hoping CDFA can chime in on. Where do the monies come from for both of the yellow lines in the annual financial statement? And I think I've got the right slide up for those two yellow lines. That's the regulatory support reimbursement.
Mm-hmm. Well, those are from your prior year's checks that are sent you for your unclaimed gas tax that was paid in the prior fiscal year that you have to account for. So those are not included in the calculation of the revenues and reimbursements, because there's that big swing sometimes, and it might show a huge calculation, and so those numbers come from the department based on what you actually received in payment from the department from a prior year's unclaimed gas tax payment. Is that clear?
I think so. Just I want to keep going just because we're over an hour now, and I want to let everybody get back to work. But next question: would ACP or GWIS treatments or quarantines be an emergency project?
Probably not, because well, if there's a quarantine and you don't have one, and they establish a quarantine, you may be able to account for some response time, but a lot of times what they do is they allow you to develop an invoice for those things and get you started on a work plan, and there's a fine line there where they actually apply that. But it'd be like if you had a medfly find and you didn't have anything to do with that before, and you had no contracts or anything going on. It's really more of a spontaneous act of response to eradicate.
Yeah. Okay.
And yeah.
Okay, yeah, I think we've covered that pretty well. Okay, if you don't meet your 5-year average, do you get the unclaimed gas tax if you are able to explain hardship?
Yes. And the crew, the team that reviews this between the department and the finance branch and the liaison and the ag commissioners working group, once the criteria is determined, it's sort of like a check off around the room. Everybody says that's legitimate. Now, we've had cases where the group would say the criteria and the discussion that you're using to justify why you should be allowed to receive your gas tax is not adequate. And we've sent back, a winnowed down list of people, a second letter back to the CAO saying the department's not satisfied with your response on what you're going to do about this maintenance of effort issue. So you need to explain again why you are in this position. And we've done that a few times, and I think it's just a matter of there is a sense of, well, we'll just respond and we'll get an exemption. And in some cases, the hardship criteria weren't met, so they had to go back to start over and restate again. So Does that make sense? We haven't had anybody not receive it, but we did have an incident with a county in Northern California where there was sort of a reluctance to comply, and it left the ag commissioner sort of in a bad spot, and they worked it out, but it was a close call because several bits of the criteria weren't being met, and we were looking at this as this is going to be a test case, and I won't name names or counties, but we've had one run right up to the wall, and we'll be able to defer away from that. But we've had the case saying you haven't met your criteria.
Yeah, I think the way to think about it is if your county administration is projecting that the general fund of the entire county is going down by 10%, and so they issue a mandate that across the board all county departments are going to, or at least general fund departments are going to experience a 10% cut, and that's why you didn't meet your maintenance of effort. That's a very, very straightforward hardship.
That's totally legitimate, but in this case,
yeah, if the county specifically goes to the ag department and says, we are going to take some of your agricultural general fund and we're specifically going to single out the ag department and move the money into what they call a below the line or outside of the department program, something that doesn't qualify, that is not an acceptable hardship, and that's what.
And specifically, in the bigger picture is when the unclaimed gas tax checks received, is that it's like just swept out of the department and used in other agencies. That's sort of like the two black eye punch.
Yeah.
So
yeah, you
all that adds.
At the commissioner level, you got to, you're going to be working with other county department heads, and the sheriff and the auditor and the assessor all think their departments are more important than your department, just like you think your department's more important than theirs, and they don't want to see their budgets cut, and they're happy to take general fund from you if that's what it takes to prevent cuts in their department. So it's that 224.5 language is put in there to protect the ag commissioner from some of these larger departments, which rightly so are just as concerned with preserving their work as you are with yours. So
okay,
next question, why is it separated? I am assuming they are asking about pesticide and ag expenditures. Stacy, did you cover why pesticide UGT is capped at $9 million?
No, I did not.
Okay. You want to just briefly explain that?
Well, go ahead.
Okay, well, historically, prior to some of this new legislation being passed, pesticide use enforcement, the ratio of other ag programs to pesticide use enforcement started growing in such a way that pesticide use enforcement started taking up a larger and larger percentage of overall ag expenditures on the annual financial statements. And so because, pesticide use enforcement is just one program within the above the line programs, a decision was made to cap the total amount of pesticide use enforcement reimbursement at that $9 million. And so that is why it's split out. And in fact, if you talk to your county leadership, they will tell you that there's actually two different checks received by the county. One is for all the other ag expenditures, and then there's a separate pesticide UGT check that is received by the county. So it's that separate at this point. Okay, next question. During a CACASA meeting at the beginning of the conferences, what financial resources or funds are appropriated at these meetings, and how are they affected by this unclaimed gas tax money? We do not give out money at conferences. That's all done as part of a process that's actually the financial statement is a report that is prepared. It is submitted to CDFA, and then CDFA sends out those checks to the county to disperse unclaimed gas tax. So the conferences are for the purpose of discussing policy. So like the policy of what criteria constitutes a hardship, that policy might be discussed at a conference, but the actual deciding how much money to give somebody or whether or not they would get money, that wouldn't necessarily be done at a conference. Next question, would it help inspectors taking the exams to view some actual documents for our individual counties? Absolutely. I think it's perfectly, having sat on the oral exam panels, I think it's acceptable, if not encouraged, to say, I work for Napa County, and I know that Napa County's annual financial statement is X dollars, and I've looked at that. I've sat down with my deputy or my commissioner, and we've gone through that, and I understand what's on my county's whether it's your annual financial statement or your Board of Supervisors agenda procedure. Each county is going to be a little bit unique, and so Board of Supervisors procedures, and the way you get an item on the agenda for the board is going to vary. Some counties require a month of lead time, some require 2 weeks of lead time, for instance. So we don't expect you on the oral exams to know the policies in that kind of a situation for every single county in the state. So therefore, it's okay to be really familiar with, hey, in Placer County or Marin County or Napa County, in the county I work for, I'm familiar with our policy on some of these things that are really specific to an individual county. Highly recommended that you familiarize yourself with those processes and documents. That is our last question that I'm showing. I want to thank everybody for attending. I want to thank Stacy Carlson in particular for presenting. This is a lot of information, and I would encourage you as you go through this PowerPoint again as you're reviewing it later on, as you have questions, go to your deputies and your commissioners and ask them those questions. They should be able to help you out, because this is a really complex thing, but it's really, really important to understand. So I thank everybody for your participation. Our next exam or our next webinar will be on the administrative civil penalty and NOPA process. Mona Montana from DPR is going to be leading that one, and she is excellent on that topic, and really looking forward to that. I believe October 23rd is the date of that, and I'll be sending you all out an invitation. So with that, I will go ahead and end the webinar. Thank you.
Thank you. Bye-bye.